Today we're going to be presenting on the WorldCom scandal. We'll discuss what led to the fraud and all of the people who were involved. Now Haley Mitchell is going to get us started with an overview.
This is the timeline for WorldCom's fraud. In 1983, AT&T broke up. In 1984, LDDS, Long Distance Discount Services, began to operate. Over the next few years, LDS grew and changed the name to WorldCom. In 2000, U.S. Justice Department rejects the merger of WorldCom and Sprint. In 2002, WorldCom announced that its profits had been inflated the past 5 quarters. Earnings management is an accounting technique to level out net income fluctuations from one period to the next. Fraudulent reporting is an illegal act of lying on the financial statements. WorldCom used 2 techniques for fraudulent reporting on its financial statements between 1999 to 2002. Accrual release from 1999 to 2000. Once this tactic was no longer available, WorldCom moved on to expense capitalization from 2001 to 2002. One of the motivations behind the fraud was to be the #1 stock on Wall Street. Epper says in 1997 the goal of WorldCom was not to capture market share or be global, but the goal was to be #1 stock on Wall Street. One way to increase the company's market value was through revenue growth. Another motivation was maintaining the revenue growth. The demand for revenue growth was in every brick in every building, says one manager. The push for revenue encouraged managers to spend whatever was necessary to bring revenue in the door, even if it meant that long-term costs of projects outweighed the short-term gains. Another motivation was pressure from upper management. As I said above, there was a push from upper management to maintain and bring in revenue to WorldCom. Eppers made a personal and emotional speech to senior staff about how he and other directors would lose everything if the company did not improve its performance. This created pressure on the employees to do whatever it took to make the performance improve. Lastly is compensation. We will talk about this later in the presentation, but I will just touch on it. Eppers and Sullivan granted compensation beyond the company's approved salary and bonuses, and Human Resource Department virtually never objected to such special rewards. Now Haley Shaw will.
Now that Haley has discussed the motivation behind the fraud, I want to explain why executives feel pressure to cook the books. Generally, this occurs because executives are wanting to improve the numbers in the financial statements. There may be pressure to increase earnings or decrease debt. There may also be pressure to meet analyst or investors' expectations, since these help to determine stock price. Binding agreements like debt covenants can present more pressure. There may also be personal motivation. Executives may own a large amount of stock, and a change in stock price can have an effect on their personal wealth. Or they may simply have a thirst for more money, and greed comes into the picture. In the case of WorldCom, one primary reason the executives altered the financial statements was because of the poor industry conditions. The telecommunications industry was facing high competition, the market was saturated, and the companies in the industry were facing declining demand. Another reason was that there was also high pressure on the ER ratio, which was one of the most important indicators of WorldCom's success. Ebbers, the CEO, felt personal pressure because he depended on his stock to finance many of his unrelated businesses. The fraud triangle provides us with an overall scope of the WorldCom fraud. The first element shown at the top is perceived pressure, which we talked about in the last few slides. This includes financial pressure, pressure from top management, and personal pressure. The next element in the bottom right is perceived opportunity. There was not a code of ethics in place, and the internal controls were very weak. There was also poor communication with the board of directors. Also, employees were told to withhold information from the auditors, which made executives see further opportunity to continue with the fraud. The last element is rationalization. Employees felt that committing the fraud would save the company and would save their jobs. Employees like Betty Vinson trusted top management and that they knew what they were doing. Even the auditor was able to rationalize. Arthur Andersen saw its relationship with WorldCom as vital since it was such a big client and they did not want to do anything to alter or lose the investment they currently had with WorldCom. An important part of understanding this fraud is understanding the corporate culture that WorldCom was operating in. One employee said that the company felt like a hodgepodge of people and cultures. Employees said they would receive calls from offices and locations they had never even heard of. WorldCom also had a very aggressive top-down management system. Employees felt like they had to do whatever they were told to do or else they would lose their jobs. Those in top management positions also demonstrated poor ethical behavior. Just one example of this was the way Ebers and Sullivan compensated people without any regard of the compensation policy that was in place. Executives also did not welcome any legal advice. WorldCom didn't have a whistleblowing hotline in place, and many employees said they didn't even know there was an internal audit department. So moving on, prepaid capacity was a major component of the fraud WorldCom committed. The company created an account called prepaid capacity that allowed them to transfer the cost of leasing fiber optic lines. As you can see from the image here, they moved the expenses from the income statement to an asset account called prepaid capacity on the balance sheet. In hindsight, this should have been an indicator of fraud because the transferred amounts were large rounded amounts. This leads us to the financial impact of the fraud. Before the fraud was detected, WorldCom was able to substantially benefit from the fraud, and they used two major techniques to help them. The first was accrual releases. Executives ordered that estimated liabilities be eliminated from the balance sheet before the bill arrived. The chart here shows how about $3.3 billion of accrual releases increasingly pushed down reported line expenses. The next technique used to cook the books was expense capitalization. Executives turned to this once the accrual technique could no longer be used. So with expense capitalization, excess network capacity was treated as a capital expenditure rather than an operating expense. The information in these tables was provided by the SEC, and the one at the top shows how income was overstated as a result of the line cost expenses being understated. From the table at the bottom, you can see how WorldCom overstated its capital expenditures by over $8 billion. So as you've seen, together the accrual releases and expense capitalization helped WorldCom reach its desired ER ratio of about 42%. The blue line on this graph indicates what the company reported the ER ratio to be, but the pink and green lines above show what it actually was before the accounting fraud. I'm now going to pass the presentation over to Lincoln so he can explain how this fraud impacted stakeholders.
There were four major stakeholders that were affected by the fraud at WorldCom. The first were the shareholders, the people who owned the stock in WorldCom. They lost hundreds, if not thousands of dollars from their investment in a variety of numbers of stock. Next up were employees, who when they lost their job, not only lost a reliable source of income, but also other benefits like healthcare or retirement funds. Thousands of employees lost their job due to this scandal. Next, the market as a whole for telecommunications was affected, as multiple companies lost thousands to millions of dollars trying to match the fraudulent efficiency numbers of WorldCom. AT&T fired tens of thousands of employees, and it even drove one company, Quest, to committing fraud, and another, Global Crossing, to bankruptcy. Finally, you have the financial institutions who loaned money to WorldCom. At the time of the fraud, $28 billion in bonds outstanding were on the books for WorldCom, and $2.65 billion in loans were from banks. There's no way that these monies were ever fully recovered. Upper management used a variety of tactics to hide the fraud. The first thing that they did was they split the different parts of the fraud amongst a variety of managers in the company. They did this so that not one person knew too much about the fraud to start uncovering anything, and also these managers were often in different offices, if not different locations in the world from the other people involved. They also only selected managers that they knew they could control through social engineering or even more menacing tactics like coercion. Upper management also limited the ability of auditors, both internal and external, to properly do their jobs, which might have led to the uncovering of frauds, by limiting the scope of their audits and also limiting their access to it. Internal audit played a large part in uncovering the fraud, if not the biggest part. Internal auditors were the people who started piecing together the individual parts of the fraud into one large picture overall, which showed the problem as a whole. There were three main players in internal audit. The first was Cynthia Cooper, who was the head of the 24-person internal audit team at WorldCom. She was the one who first started the uncovering process of the fraud in the middle of 2002. Next, you have Gene Morse, who was a senior manager at Internal Audit, and he was actually the one who did a majority of the searching and digging and finding of evidence because he had access to all of the financial information and records. Finally, you had Glenn Smith, another senior manager, who helped a lot towards the end with confronting managers in WorldCom about their role in the fraud, but also helped Gene Morse with the digging and finding of evidence. Next, we're going to give a brief overview of Cynthia Cooper, especially the ethical behavior and decisions that she had to face. She was intimidated by Scott Sullivan when she first started to uncover the fraud. This is shown in a variety of ways, specifically when she had a confrontation with Scott, where he yelled at her in a way that she had never been spoken to before. Along with just that, Scott used his powers as the CFO to flex his muscles a bit, limiting the scope of her audits and her access to information. Cooper also faced an ethical dilemma with this fraud uncovering process. As she started finding things, you have to think, should she go against the people who hired her and who have been loyal to her as a company, or should she do her best and release the information to the general population? Ultimately, she knew where her ethical obligations lay, which was to the general population, specifically investors, where she had to show them that the numbers on the books were listed fairly and materially, and they were not. Chelsea is now going to continue with this overview of Ms. Cooper, and she'll also speak about who's most at blame for the fraud.
Cynthia Cooper was obligated to report directly to the CFO, Scott Sullivan. Having had direct access to the CFO not only exposed Cooper to the company's financial reporting process, but also undermined the department's independence and greatly stifled information regarding potential fraud that needed to flow to the audit committee. In other words, the relationship between WorldCom's CFO and internal audit function impeded the independence of the department and should have been deemed as a serious scope limitation. In order to achieve independence, objectivity, and fulfill necessary obligations, I recommend the internal audit function report functionality to the audit committee and report administrative items to the CEO. Cynthia Cooper really only had two options after becoming suspicious of fraudulent activity. She could either go outside of her assigned responsibilities and investigate what seems like a potential fraud, or she could simply do nothing. Going down the investigative route, Cooper would have faced the possibility of exposing her employer of committing fraud. Once that information were to become public, stock prices would fall, employees would lose their jobs, and shareholders would lose their investment. Then again, she may very well have discovered nothing fraudulent. In that case, she more than likely would have been fired for violating employee policy. On the other hand, Cooper could have made the decision not to investigate any further. But would she have been able to live with the guilt after finding out that she was right to begin with? Even without the investigation of internal audit, I believe the SEC would have investigated WorldCom based on the fact it was the only telecommunications company that had continued revenue growth in its industry. This irregularity would have surely caught the SEC's attention, and WorldCom's fraudulent activity would have been discovered anyway. Cooper chose to go down the investigative route with the help of internal audit, Gene Morse and Glenn Smith. The investigation revealed inappropriate capitalized expenses, including $3 billion in questionable expenses and $500 million in undocumented computer expenses. After further review of the case, it does not seem Cooper was motivated by fame or money, but rather her own moral compass. Now we will shift our discussion to Betty Vincent, the Director of Management Reporting. Betty Vincent can be viewed as both a victim and villain depending upon perspective. Vincent had the reputation of being a hardworking, loyal employee who was extremely dedicated to her profession and would do anything if asked. When Vincent was ordered to release $828 million of line accruals into the income statement, she dealt with much uneasiness and an internal struggle was born. Vincent agreed to the transfer, but was assured it would never happen again. After the third quarter results were published, Vincent was even overcome with guilt and planned to resign. Once again, though, she was convinced she was doing nothing illegal. She ultimately decided against quitting for the sake of her family's financial well-being. At the time, she was the primary breadwinner, and WorldCom paid for her family benefits. She was driven by the fear of not being able to find an alternative job with similar compensation. Moreover, she put too much trust in the expertise of the CFO. The pressure to make these inappropriate entries caused her to withdraw from co-workers, lose weight, and not be able to sleep. Later, Vincent admitted to internal audit she made inappropriate entries to inflate earnings at the request of upper management. In the eyes of the law, however, Betty Vincent was viewed as a criminal. Her criminal actions were investigated by the SEC. She pleaded guilty to 1 count of securities fraud and 1 count of conspiracy to commit securities fraud. Regardless of either perspective, Vincent's decision not to further question seemingly inappropriate accounting practices, not to report behavior to the audit committee, and not to stand up to her bosses made her the villain in the endgame. Job security and fear overcame her moral compass to do the right thing. The board of directors and the external auditors were not completely blameless in the demise of WorldCom. For instance, the board of directors' only primary interaction with WorldCom occurred at regularly scheduled meetings 4 to 6 times a year. In addition, none of the outside directors had direct contact with WorldCom executives. The outside directors never even met by themselves. According to an investigative committee, the board seemed distant and detached. Board meetings were fairly robotic in nature. On the other hand, Arthur Andersen, the external auditor, placed its client relationship with WorldCom on a pedestal. WorldCom seemed as the crown jewel of all potential clients. As a result, Arthur Andersen justified underbilling the client as a continuing investment in the relationship. Accounting procedures were not properly followed. The external auditors focused on the risk revenues would be misstated due to errors or inaccurate records, not by deliberate misrepresentations. The auditors did not modify its analytic approach. It continued to assess WorldCom as a moderate risk client instead of a maximum risk client. If accounting procedures were executed properly, they would have triggered a search for irregularities. However, Arthur Andersen auditors seemed comforted by the fact their client had stable revenue growth in a period of severe decline in the telecommunications industry. In the end, a small group of dedicated internal auditors worked together to discover one of the largest accounting scandals in history, sending their employer down the path to bankruptcy. Now, the infamous WorldCom events serve as a lesson to accounting students everywhere. On behalf of my group members, I would like to thank you for your time and attention.